Okay, we're back and now ready for the conclusion of our Chapter 7 video lecture. I want to revisit this concept of how to account for a bond issue at a discount. So remember again, the bond has a face value of $100,000, but it was sold for $95,000. And that's because the bond's stated rate of interest was less than the current market rate of interest. That $5,000 has to be amortized or reduced over the life of the bond. So to do that, because the bond matures in 5 years, we do what's called straight line amortization. We're going to take the amount, the $5,000, and divide that by 5 years. Therefore, every year we're going to reduce that discount in the amount of $1,000. We're also paying $9,000 in interest each year to the actual bondholder. So on the balance sheet, our cash is going to decrease by $9,000. Your bond's carrying value is going to increase by $1,000 because as you reduce the discount, that's going to increase the bond's carrying value. Under retained earnings, it decreased by $10,000 because you're showing a total of $10,000 in interest expense. The expense is the $9,000 being paid to the bondholder plus the $1,000 being amortized for the bond discount. On your statement of cash flow, the actual cash outflow is $9,000 for the payment to the bondholder, shown as an operating activity. Next, we sold the land for cash and we sold it for $95,000. So when you actually sold the land, your cash increased, land account decreased, $95,000 cash inflow, so the cash flow, as an investing activity. So now that we've actually sold that land, we're going to pay the bond off. But remember, when you pay the bond off, you're paying the face value of $100,000, not $95,000. Therefore, the total cash paid would be $100,000. The bonds payable account would decrease by $95,000. $95,000 amount being paid is shown as a financing activity because that was the amount that we actually received for the bond. The other $5,000 was shown as an operating activity, which is going to be for the discount on that bond account. Okay, so that 5,000 for the discount is shown as interest expense, and therefore it goes upon the operating activity section of your statement of cash flows. Okay, so here is a summary of the bond issued at discount. Here is showing the rent revenue each year, the interest expense, and the net income. The land account again had a value of $95,000, but once it was sold in year 5, it's down to zero. Here's what I want you to really focus on. The bonds payable account was $100,000. That's the bond's face value. The discount on bonds payable was reduced by $1,000 at the end of each year till it was down to zero in year 5. But you also paid that bond off in year 5, so your liabilities decreased because the bond was paid off at the end of 5 years, which was the maturity period. On the statement of cash flows, this is showing the inflows and outflows of cash from your operating activities, investing and financing each year. So on the operating, it's the same all 5 years. For investing in year 1, when you first bought the land, that was an outflow. How did you buy it? You financed that through issuing bonds. That was an inflow. And then in year 5, we sold the land. That was an inflow on investing. And we paid off the actual bond. That was an outflow under financing. And this is showing our cash balance at the end of that 5-year period. Okay? So bonds can be issued at a discount. They can also be issued what's known as a premium. So when bonds are issued at a premium, it means those bonds sold for an amount above their face value. So now you're saying, well, why would a bond sell for an amount above its face value? That happens when, write this down, when the bond's stated rate of interest is higher than the current market rate of interest, bonds will sell at a premium. Again, when a bond's stated rate of interest is higher than the current market rate of interest, those bonds will sell at a premium. So, for example, this bond has a 9% stated rate of interest. When this bond sells, if the current market rate says only 8.5% interest, then my bond will sell at a premium because I'm paying you a higher interest rate than you can get on similar bonds. So when a bond issued a premium, such as 105, if this number is above 100, it means a bond was issued at a premium, an amount above its face value. If this says at 100, that bond was issued at its face value. If this number is below 100, that bond was issued at a discount. So this bond was issued at 105, which means 105% of the bond's face value. So we're receiving cash a total of $105,000. So we still only paid back 100,000. You only paid back the face value of the bond, which is $100,000. The difference between the amount received, 105,000, and the bond's face value will reduce the interest expense we're going to recognize over this 5-year period. So let's do some calculations, shall we? So now we have a new account title called Premium on Bonds Payable. Remember, when a bond was issued a discount, it had a discount on bonds payable account. But because now the bond was sold at a premium, you have an account called Premium on Bonds Payable. Okay? So on your financial statements, in the balance sheet section, you show the bonds payable for 100,000. The premium is added to the bonds payable to get its current value of $105,000. Now, same concept as before, the amount of interest paid to the bondholder is going to be $9,000 per year. That's based upon the face value, $100,000, and the interest rate of 9%. All right. So the bond was first issued. Our cash increased by $105,000. Your liabilities increased by 105 as well. That's the current value of the bond. On your statement of cash flow, there's an inflow of cash from 105,000 shown as a financing activity. Now, this premium will also be amortized over a 5-year period using straight line amortization. So you take the 5,000 divided by 5 years, you're going to amortize 1,000 per year. On December 31st, you're going to pay the bondholder 9,000. That's going to be the reduction in cash. You're going to recognize the amortization of that premium of 1,000, and your stockholders' equity is going to decrease by 8,000, which is your interest expense. So notice the interest expense would be the amount of cash paid minus the reduction of that premium. Because although the bond has a 9% stated interest rate, you're paying them less in interest because you receive 105,000. So like we did before, let's do some calculations. Get my calculator out again. So remember, you're paying them $9,000 a year, right? But they paid you 105,000. So do me a favor, take 9,000 and divide that by 105,000. Again, take 9,000 divided by 105,000. That'll give you 8.57%, which means that the effective interest rate is actually less than the stated rate, and that's because your bond was issued at a premium. Okay? So again, the market rate of interest refers to the current interest rate you can receive on bonds that have a similar level of risk. So the effective interest rate when a bond is issued is going to be equal to that current market rate. And again, the rates are different because you cannot change the rate on the bond certificate. That's the stated rate. So again, your bonds may have been first issued on the 1st of January, but didn't sell until maybe June the 1st. Well, by June the 1st, the market rate is going to be different than what it was back in January. So when your bonds sell on June the 1st, they're going to adjust what's called your interest rate on your bond to determine what is the effective interest rate. So depending upon if your stated rate of interest is higher or lower than the market rate, that will show if that bond will sell at a discount or at a premium. So when the market rate is higher than the stated rate, the bond will sell at a discount. But if the market rate is lower than the stated rate, that bond will sell at a premium. So make sure you remember those concepts. Okay? In general, large loans with large long terms to maturity pose more risk to lenders than small loans with short term. So to reduce the risk, lenders pledge assets as collateral for loans. So I'll give you an example of that. If you have a mortgage, your home is collateral for that mortgage. Because if you do not pay the mortgage as it is due, that lender has the right to seize your property. Okay? The last section focuses on the difference between current and non-current assets, distinction between current and long-term liabilities. Okay? So a current asset is an asset that we expect to be converted into cash or consumed within 1 year or an operating cycle. And again, for our purposes, we're going to always use 1 year as the accounting period. So these are examples of different types of current assets: cash, market securities, account receivable, etc. Different type of current assets. When you have current or short-term liabilities, these liabilities will be due within 1 year. So example would be accounts payable, short-term notes payable, wages payable, examples of different type of short-term liabilities. On what we call a classified balance sheet, the word classified means categories. Then the assets are broken down between current and non-current. The liabilities are broken down between current liabilities and non-current liabilities. So here we have a sample classified balance sheet. First, you have your current assets section, followed by your long-term assets section. Note that each section has its own subtotal. And then for the liabilities section, here we have your current liabilities broken down by and then your long-term liabilities. Okay, and once again, each section has its own subtotal. So with a classified balance sheet, you all like how that flew up there? Do it again. Okay. So again, with a classified balance sheet, you're going to have it broken down to categories: current assets, long-term assets, current liabilities, and long-term liabilities. Thank you, and I hope you've enjoyed our Chapter 7 video presentation. Bye-bye.